Hi, I'm Ross O'Brien with the Economist Corporate Network in Hong Kong. We've just wrapped up our quarterly Asia Intelligence Update session, where we've taken a look at the region's economies with a focus on the outlook for mergers and acquisitions in the region. I'm joined by Austin Sweeney, partner with Herbert Smith Freehills, and Simon Weller with Freshfields Brockhouse Derringer. Gentlemen, thanks for your time this morning, and thanks for a very interactive session. Austin, you had presented a fairly cautiously optimistic outlook for M&A in the region, and particularly what you noted was driving big ticket items was, of course, demand for natural resources, and that in turn driven by thumping demand in economies such as China and East Asia in general. Will the energy M&A boom persist into the future?
Yeah, I mean, I would be cautiously optimistic. It's not one size fits all. Mining stocks are down. There are lots of mining sellers right now, very few buyers.
Right.
So if you take coal to one side and say that we aren't expecting imminent activity there. Oil and gas much more flexible, and as long as the North Asian economies continue to be relatively resource poor and continue to drive their economies and need to drive those by importing resources, we will see that capital flow of Chinese, to some extent Korean and Japanese investors.
Yeah.
Looking down to particularly Southeast Asia and Australia to acquire those resources. I can't see anything changing there absent dramatic slowdowns in growth that will mean less demand, or dramatic technological developments which will push investment into renewables or the like.
Right.
That will continue as a constant, but it's not going to surpass oil and gas.
Right.
So I think we will see that as a relative constant. However, there are other areas, other bright spots, other sectors. I think investors from out of the region, particularly Japan and Western investors, will be looking to maximise the GDP play. So get their growth by investing into these still emerging economies, where in areas like insurance and banking and the like, they will be able to get returns that they will be able to get in their home economies. And then there's the wild card, I suppose, as well, in terms of the opportunities offered by, I think it was Mongolia last year. This year is Myanmar.
Right.
These unknown economies where the veil has been pulled back, and the MNCs have now got opportunities to look to invest in those markets to get at consumers who to date have been outside their reach. So I think we will see that, possibly some, almost certainly smaller ticket,
right.
But we will see opportunities there.
But will investors look at places like Mongolia and Myanmar through the lens of experiences in other kind of hot emerging economies that have traditionally been somewhat schizophrenic, shall we say, about foreign investment, such as Indonesia, which has been obviously one of the most interesting opportunities of late for all the reasons that you mentioned, energy plays plus the consumer play, but has of late become overly nationalistic. Has Indonesia, or rather do you fear that Indonesia-type tactics might dampen emerging market opportunity more generally?
But possibly. I mean, we have seen a rather haphazard approach to regulation, I think, in Indonesia. Some of that is outside the political ability of politicians to control it.
Right.
BP Migas's collapse was a judicial decision, however, we have seen, without doubt, nationalism, resource nationalism, less so now as the heat has come out of the mineral sector, but there was certainly last year resource nationalism there, and increasingly also, the DBS Danamon, that deal and the delays it's faced have really suggested that it isn't necessarily a level playing field for all external investors.
Yes.
With the more, with the newer markets, particularly Myanmar, I think there's actually a different concern. They haven't even got to that stage. Right now, the concerns there are actually more simple. It is, can we prove that when we write that check, we're going to get that stuff? It is somewhat more simple. Concerns about land title, concerns about corruption and the like, and there continues, albeit that the sanctions have been lifted. There continues to be lists of people that you cannot do business with there, related to the old regime. So it is those concerns I think will be more to the fore. Perhaps in time you'll get other concerns to do with consistency of application of regulation and the like.
Yeah. Now, Simon, another big thread within the regional M&A tapestry has been China and China's outbound aspirations, and there's been another set of both nationalistic concerns, or rather concerns about China's intent abroad, which is complicated. Certainly strategic deals in the US and elsewhere, but there's also been something you spoke of, a China premium that often has been required by acquisitive buyers from the mainland. And I wanted to start there with you. Is the notion of this China premium to stem from the fact that China represents an uncertainty or a risk for the seller, or has it been simply a move by Chinese buyers to kind of cut through the perception gap that often comes with East-West M&A transactions?
I think that the China premium itself has really been driven by the uncertainties from a sell-side perspective as to the deliverability of a bid, and how credible is the Chinese bidder? Are they really going to be there when we can sign the deal, and then when we close it in a number of months, are they going to be there? Are we going to get to closing?
Yeah.
And when you have a competitive auction in Europe or the US, you clearly want to make sure the auction is successful. So you have other bidders, and you have to value the risk of getting the Chinese approvals.
Right.
I think people are getting more comfortable with some of those risks, and perhaps we're also seeing sometimes somewhat less competitive auctions, which might drive in favour of some of the Asian bidders, so the Chinese bidders.
Okay.
And I think also there's an evolving experience within Europe and the US. People are getting more used to the way Chinese bidders operate.
Right.
And there's also a sophistication as to the approach you have for. If you would like to have an Asian bidder in your auction, if you're selling an asset, then why not make it easier for them to participate? So let's take into account the cultural issues, the regulatory issues they're going to have. Perhaps they may be, in some senses, slower to react and not be able to keep up with a European or a US private equity house who may also want to bid on an asset. But they can, if you can bring them up the curve, if you can front run an auction process to help them to make sure they can be there at the end. I think that really levels the playing field somewhat, and that's certainly been something we've seen across Europe and in the US.
Now, Austin spoke of this GDP play from Western or Japanese buyers buying into high growth emerging markets in Asia. What are some of the driving elements of China's outbound aspirations? They're certainly at 7.5% GDP growth. They're certainly not betting on anybody else's economy bringing them economic upside. What are they getting out of these deals?
Well, there's the obvious resource hunt for resources, and that's driven a lot of the deal volume, the actual dollar values of M&A deals. I think there's a bit of a shift as well, though. So it's not just the SOEs going out looking for the resources, or utilities. There's also the privately owned enterprises going out to Europe or the US looking for different businesses, and they
Right.
may be looking for management skills, sort of IP, sort of brand, looking for businesses they can bring to China. And it's not necessarily all about the export from China to Europe or to the US. I think it's also about bringing successful businesses into China to really target the China audience and the sort of the growing population, increasingly wealthy population that can afford to buy, for example, luxury goods. So I think that's a big piece.
So in a sense, it is a GDP play. It's just on their own GDP.
Yeah, I mean, I would say it's almost an anti-leakage. You know, they realise they're going to spend this money.
Right.
So let's keep it in our own pockets to
Right.
a certain extent. So you see that with, for example, investments into leisure, hotels and hotel management companies in
Right.
Europe. Those hotels will be full of Chinese tourists in the years to come.
Yep. Now, as a final point, Simon, you had indicated that European sellers are becoming more accommodative of buying practices and communication styles over the table from their Asian clients or potential Asian clients. Is there a sense, and without being sort of Euro-apocalyptic about this, that that European sellers are heading into their second year of contraction and are perhaps looking to sell assets because they simply have to? In other words, do you get a sense in looking at the deals on the table that European sellers, perhaps more so than your North American counterparts, are getting more desperate? And if so, what does that imply for the future of China's outbound aspirations?
I'm not sure there's a desperation in Europe, and I think actually prices are not as depressed as perhaps people might have thought. And certainly I think there is a fair degree of competitiveness in European M&A.
Okay.
Certainly there are some forced sellers out there, and particularly in the FIG space. I think there has been a lot of non-core divestments, which we've seen around Asia. There's been some divestments forced through the sort of state aid decisions from back in 2008 through the GFC. So there are some forced sellers, but there are some very good assets there, and I think Chinese buyers are looking to buy the quality assets. They're not looking to buy the poorer quality assets. And I'm sure there's always going to be competition for the real quality assets.
Right. Good point. Awesome, Simon. Thank you very much for your time today. I'm Ross O'Brien. You've been watching our wrap-up of the Asia Intelligence Update here in Hong Kong. Thanks very much for watching.